In the world of corporate finance, companies classify their expenses into two primary categories: capital expenditures, CapEx, and operating expenditures, OpEx. These two types of expenditures play distinct roles in a company's financial strategy and reporting. While both impact a company's bottom line, they do so in different ways and are treated differently for accounting purposes. Understanding the key differences between CapEx and OpEx is crucial for businesses, investors, and accountants in managing resources effectively and making informed financial decisions. In this video, we explore the top 10 differences between capital expenditures, CapEx, and operating expenditures, OpEx. 1. Definition. Capital expenditures, CapEx, refer to long-term investments made by a company in assets that will be used over a longer period, usually more than 1 year. These expenditures are often for tangible assets like equipment, machinery, real estate, or intangible assets like patents and software development. Operating expenditures, OpEx, on the other hand, represent the day-to-day expenses a company incurs to run its business operations. These expenses are short-term and typically involve the costs of goods sold, rent, utilities, salaries, marketing, and other necessary costs to maintain operations. 2. Accounting treatment. The key distinction between CapEx and OpEx lies in how they are accounted for. CapEx is capitalized, meaning the cost is spread over the useful life of the asset through depreciation or amortization. This allows the company to match the cost of the asset with the revenue it generates over time. OpEx, on the other hand, is expensed immediately on the income statement in the period in which they are incurred. These are not capitalized and are fully deducted from revenue in the year the expense occurs, reducing the company's taxable income for that period. 3. Impact on financial statements. Because CapEx is capitalized and depreciated over time, it impacts both the balance sheet and the income statement. On the balance sheet, the value of the asset appears as a long-term asset, while depreciation expenses appear on the income statement. OpEx, however, only affects the income statement as they are recorded as costs in the current period. 4. Duration of benefit. CapEx involves investments that provide benefits over a long period, often several years. For instance, purchasing a new factory or upgrading machinery will yield returns over many years. As such, these expenditures are considered long-term investments for the company's growth and efficiency. In contrast, OpEx relates to short-term expenses that are necessary for day-to-day operations, such as paying salaries, utilities, and rent. These expenditures do not offer long-term benefits and need to be incurred regularly to maintain ongoing business functions. 5. Tax implications. Because CapEx is depreciated over time, its tax benefit is spread out over the asset's useful life. While the initial outlay may be large, the tax deductions from depreciation occur gradually, which can result in a delayed tax benefit. OpEx, however, offers immediate tax benefits, as these expenses are fully deductible in the year they are incurred. Companies can lower their taxable income more quickly by expensing these operational costs in the same year, reducing their overall tax liability. 6. Impact on cash flow. CapEx requires significant cash outflows at the time of purchase or investment. However, since the cost is capitalized and depreciated over time, the immediate cash impact may be less severe when compared to the full cost recorded on the income statement. CapEx usually results in a negative cash flow initially, but it's offset by depreciation and potential asset sales. OpEx involves smaller, more frequent cash outflows that are required to keep the business running. While these expenditures don't have the large initial cost of capital investments, they accumulate regularly and can strain cash flow if not properly managed, especially if a company is operating on thin margins. 7. Nature of the expense. The nature of CapEx tends to be for the acquisition of assets or upgrades that are expected to help the company generate long-term value. These expenditures are typically planned and carefully managed, as they have a significant impact on a company's financial position. OpEx, on the other hand, relates to ongoing operating costs that are necessary for keeping the business functioning day to day. These expenses are often recurring and generally don't result in the creation of long-term value or assets. 8. Strategic considerations. CapEx decisions are often made with long-term strategy in mind. For example, A company might invest in new technology, expand its facilities, or acquire another company to enhance its capabilities or market reach. These expenditures are typically more capital-intensive and require careful planning and justification due to their significant financial impact. OpEx decisions are generally more short-term and are part of day-to-day operations. While important for the sustainability of the business, these costs are less likely to be tied directly to strategic goals and tend to have a more immediate impact on the company's financial performance. 9. Examples. Examples of CapEx include purchasing property, buildings, machinery, vehicles, or upgrading computer systems. These investments are expected to generate returns over several years and are often significant in size. OpEx includes expenses such as employee salaries, office rent, utilities, raw materials, and advertising costs. These are recurring expenses necessary for keeping the business operating smoothly but are not linked to acquiring or upgrading long-term assets. 10. Risk and flexibility. CapEx typically involves a higher level of risk due to the large investment required and the long-term commitment involved. The company may face difficulties if the anticipated benefits from the asset do not materialize or if market conditions change. Furthermore, once a company commits to CapEx, it is often difficult to reverse or reduce the investment. OpEx, on the other hand, is generally more flexible. Businesses can scale back on OpEx by cutting costs such as marketing, labor, or maintenance if needed. Since these expenses are ongoing and relatively short-term, they offer more leeway for adjustments based on current financial conditions. Understanding the differences between capital expenditures, CapEx, and operating expenditures, OpEx, is essential for managing a company's finances effectively. CapEx involves long-term investments in assets that provide future benefits and is capitalized over time, while OpEx refers to short-term operational costs that are expensed immediately. Each type of expenditure has distinct accounting treatments, tax implications, and impacts on cash flow. By balancing CapEx and OpEx, companies can plan their financial strategies, manage resources efficiently, and maintain profitability in both the short and long term.